This is Matt Rastusha, the Chief Investment Officer at Argent Wealth Management, reviewing the September 2023 Argent Wealth Management Market View. A little bit about Argent to start, our differentiation being that we practice tax, estate planning, and investments under one roof, helping to simplify your life. You can follow us on our blog at argentwm.com/blog.html, on Twitter and Instagram at Argent Wealth, on Facebook at Argent Wealth Management, and you can find us on LinkedIn as well. So let's get right to the conclusion before we review some backup slides. Although the stock market can be volatile, there are patterns that tend to repeat, and we are seeing that. History would suggest the current bull market will continue through 2024, which I think is a non-consensus view. And August to October tends to be a weak seasonal time of year, so it's not surprising to see markets be a bit more volatile than they were earlier in the year. The main risk is that the Fed has or will tighten too much, and this could eventually cause a recession. That is something that most people already know. So let's look at some secular and long-term market cycles. Currently, we are in a long-term bull market that started in March of 2009. So that's about 14 years. The last two long-term or secular bull markets lasted 18 years and 24 years. So we're well within the time frame that a bull market could last in stocks. Cyclical stock markets historically occur within secular cycles have followed a four-step pattern. First, you get a recessionary bear, which we saw during COVID. That was a recessionary bear market. Then you get a post-recession bull. These tend to be pretty powerful and pretty strong as earnings recover from deeply depressed levels. Then you tend to get a non-recession bear. That's step three. And we got that in 2022. There wasn't a recession. Markets corrected in that 25% plus minus range. And then you get a new bull market. And that's what we're in now. And that started last October. And the current cycle is certainly looking like historical cyclical cycles within long-term cycles. And to confirm this, when you look at non-recessionary bear markets like we saw in 2022 and the history of those, what we saw in 2022 aligns with the time, about 200 days, and decline of about 25% that you typically see historically on average in a non-recessionary bear market within a long-term bull market, which is what I believe we are still in. So we are seeing a lot of alignment with history, historical market patterns, and what we've seen over the last, 4 years or so. And if you look at the history of bull markets, and it is yet to be seen if this bull market is going to end up resembling historical average, but if it does, the mean for all bull markets is an 85.9% gain over 576 days. Using the Dow Jones Industrial Average, the current bull market is about 225 days old and is up about 20%. The mean for cyclical bull markets within secular or long-term bull markets is 105.3% gain over 751 days. So if we are following historical patterns going forward like we have for the last few years, investors should expect the bull market to last through 2024. We're also seeing a very similar seasonal pattern. The stock market tends to exhibit those. If you're looking at this chart, there's a blue line that represents a forecast of historical seasonal patterns would portend for the S&P 500. These are based on the 4-year presidential cycle plus annual seasonal cycles when the stock market tends to be weak or stronger. And the dotted orange line is what has actually happened. And if you can see this, you can see the dotted orange line has followed that blue line very closely, the forecast of what would an investor expect to happen based on the historical 4-year presidential cycle and annual seasonal cycle. So again, alignment here of patterns. That is the theme. And if you just look at the presidential cycle and where we are, if you're looking at this chart, you can expect seasonal weakness this time of year in the presidential cycle, and maybe even to start next year before the bull market continues towards the end of next year, if we do in fact follow what is a typical presidential pattern for stock markets. Sentiment, always very important. We know it's best to buy, if you look at data and history, when there's more fear than optimism. And if you look at Ned Davis Research's trading sentiment poll, it went to neutral in August as the market went down. Would not surprise me to see that go to the pessimistic zone before this seasonal weakness ends and the bull market continues. Valuations, not cheap. Certainly small cap looks more attractive than the S&P 500, and the all cap world index looks more attractive than the S&P 500 as well, although the all cap world index tends to look more attractive relative to the S&P over time, whereas small cap not necessarily. So maybe small cap is a good area to be a bit overweight at this time. Although PEs are high, earnings estimates are increasing, and that can put downward pressure on the price to earnings ratios. So maybe they are not as high as they look at the surface. Now let's get into some economic data to back up why it's unlikely, I think, the bull market stops. There still remain, even though it's coming down due to Fed tightening, 1.5 times the number of job openings per unemployed in the US, suggesting there remains more demand than supply for labor. Yet that is coming down, and that also means that the wage growth tracker the Atlanta Fed produces is also coming down, which is positive for inflation pressure. Inflation pressure is coming down, that is. Credit conditions, the availability of credit to consumers and businesses is actually improving, not worsening. If a recession was imminent, which would cause, the bull market to end, you would see credit conditions worsening. And inflation is clearly coming down as well. The job market remains robust, credit conditions are improving, and inflation is on a downward trajectory. What is wrong with that? And the Federal Reserve currently expect maybe one more increase before they stop their tightening cycle. We still have not seen the full effects of the fastest tightening cycle in history on the economy. So you can't rule out a recession in 2024, late 2024 more likely, or 2025. However, don't forget, the Fed now has more room to lower rates with traditional policy tools than they've had since 2001, which is the last time we saw the federal funds rate at this level of 5.25 to 5.5%. And although many investors focus on the Fed and stimulus from the Fed has tightened significantly. But overall stimulus, when you look at fiscal stimulus, a lot due to COLA, or the cost of living adjustment for Social Security, which was due to inflation, we are seeing that, if you look at this chart, actual stimulus is trending positively, which tends to be pretty strong for markets. When this measure is above 8.8, as it is now, stocks gain 16.43% per annum on average since 1/31/1974, according to Ned Davis Research. And look at the consumer. Consumption is about 70% of GDP in the US. The US consumer has had higher than normal excess savings. Part of the reason is due to the extraordinary stimulus from COVID-19. But after-tax disposable income remains robust and is actually trending positively. That's real disposable income. That's after inflation. That is still trending positively. Therefore, the economy could stay resilient and even grow despite the fastest tightening cycle in history. And that may also explain why credit conditions remain pretty strong. Confirming this is the strength of the consumer is the balance sheets. You look at financial obligations ratio, which includes vehicle leases, rent, insurance, property taxes, and includes debt payments, and that is well below the average of history and very well below where it has been historically prior to a recession. So the consumer remains in good shape, and again, that is 70% of what drives GDP. One thing that is worrisome is that the yield curve is inverted. Short-term yields are generally higher than long-term yields. And historically, many investors would say this portends a recession. When long-term yields are lower than shorter-term yields, banks are less willing to loan money. because they pay on short-term deposits and lend long-term, and that makes it unprofitable to lend. That tightens credit conditions. As we showed you before, credit conditions actually are not tightening. And one thing that we haven't seen in a very long time is that the Fed is fighting inflation. For most of the time since the global financial crisis, 2008, 2009, the Fed was fighting deflation. So many investors are not used to seeing the yield curve actually reflect inflation expectations that may be higher near term than long term, and therefore demand a higher yield short term to compensate for higher inflation near term than they do long term, because many investors expect inflation not to be as high longer term. And that concludes this narrated version of our September 2023 market view. Please don't hesitate to reach out if you have any questions. Reading from the appendix, we do believe in Bitcoin long term. If you have any interest in that, please don't hesitate to reach out. Argent runs custom accounts for clients, and in addition to custom accounts, we run macro strategies using ETFs and mutual funds. We have a tactical macro strategy, and we also have a high dividend strategy using stocks, a value strategy with stocks, a growth stock strategy, and a long short stock strategy, all liquid, all with low minimums for our clients. And we also run private equity and private real estate, and we've been doing that since 2006 with some great partners. If you want to learn more about what Argent has to offer on the investment side, the estate planning side, or the tax side, please don't hesitate to reach out. You can contact us at contact@argentwm.com.